Oh, you will be seeing these videos, these three videos Thursday. And I got to tell you, I've got a great lineup. The next video is an interview with none other than David Morgan of the Morgan Report, followed by the new WebBot Report release summary. But first, we are starting out with a great article from wolfstreet.com, Mr. Wolf himself. He's got an interesting headline here, and it makes perfect sense. As I've always said, all markets are rigged. Stocks, currencies, commodity, all of it. Dow, the new 20,000 Dow. Dow companies report worst revenues since, most of them, by the way, since 2010. Dow rises to 20,000. Most, and there's a list in here, most of these big companies that are in the Dow, because again, the Dow Jones is a group of companies, and most all of them are big companies. And some of the worst hit are the biggest of the big companies in the Dow. So again, horrible revenue report. Dow Jones hits all-time high 20,000. The Dow Jones, or as he says, the Dow 20,000 hats have come out of the drawer after an agonizingly long wait that had commenced in early December, with the Dow Jones Industrial Average tantalizingly close to the sacred number before the selling started all over again. What a ride it has been from the beginning of 2011 through January 27th, 2017. So a little more than 6 years, the Dow Jones Industrial Average has soared 73% from 11,577 to 20,094. He says, glorious. But when it comes to revenues of the 30 Dow component companies, a reality that is harder to doctor than X bad items adjusted earnings per share hyped by Wall Street, the picture turns morose. The 30 Dow component companies represents the leaders of their industries. They're among the largest, most valuable, most iconic American companies, and they're periodically booted out to accommodate a changed world. For example, in March 2015, AT&T was booted out of the Dow, and Apple was inducted into it, as its ubiquitous iPhone had become the modern face of telecommunications. New blood with booming revenues replaces the stodgy old companies. In aggregate, revenues should therefore rise, right? And there has been a huge binge of acquisitions, from mega deals such as Verizon's $130 billion acquisition of Vodafone in 2013 to the many dozens of smaller companies that Apple, Cisco, IBM, and others have bought. These mergers bring the revenues of the acquired companies into the revenues of the Dow components, and in aggregate, revenues of the Dow companies would therefore soar, right? But the other day, I was asked about the revenues of all Dow components after having lambasted the revenue debacles of two, IBM and Cisco. So here we go, fasten your seatbelt. The chart below shows total aggregate revenues as reported under GAAP or GAAP by the 30 companies that are today in the Dow Jones Industrial Average. This includes Apple, for example, though it only joined in 2015, and it no longer includes AT&T. For 2016, these 30 companies reported aggregate revenues of $2.69 trillion. That's down 4.4% from 2011, and the worst year since 2010. Okay, you say it's the oil bust's fault. The energy companies did it. Sure enough, there are two huge energy companies in the Dow. That would be ExxonMobil and Chevron. Alas, the revenue started dropping long before the oil bust occurred. Oops. Revenues peaked in 2011 for both of them at a combined $740 billion. By the end of 2014, before the oil bust hit in earnest, revenues had already dropped 16% to 624 billion. And by 2016, they were down to 351 billion, having plunged 53%. Of the Dow components, 4, including ExxonMobil, have not yet reported their earnings for fiscal quarter 4 of 2016. To approximate revenues for the fourth quarter, I took the year-over-year growth rate of the first 9 months and applied it to the revenues as reported in quarter 4 of 2015. It's not perfect, but it's close. And given the vast aggregate numbers, trillions, any divergence for that quarter gets lost in the rounding error. So here are the revenues of the Dow components without ExxonMobil and Chevron. And I'm going to show you the chart that matters in a minute. Aha, you say, it's all about the oil bust fault. Without the oil companies that have been ravaged by the oil bust, revenues are fine. Okay, maybe not fine. Revenues without the oil companies are up 13% since 2011. That's an average annual growth rate of 2.5%, barely above the rate of inflation. Because again, inflation, we always see that as 2%. But the Dow Jones Industrial Average hit 20,000 with the oil majors in the average. So in looking at the relationship between aggregate revenues and stock price movements, we need to leave them in the mix. And reality looks even worse. Apple, whose revenues have skyrocketed by over 1,000% since 2006, from 19.3 billion to 216 billion, became a Dow component in 2015, replacing AT&T. And its revenues weren't part of the 30 Dow components until 2015. So here's what the aggregate revenues of the Dow components look like without Apple. Again, I'm going to show you a chart in a minute. And without Apple, but with AT&T, a pure stagnation fest. In both scenarios, revenues in 2016 were lower than they had been in 2008. Only 2009 and 2010 were lower. So in terms of revenues, 2016 was, for the Dow components, excluding Apple, the worst year since 2010. And this, despite the 5-year binge in acquisitions. So how have the last 2 years been? Don't even ask, he says. Of the 30 companies in the Dow, which I'll go ahead and show this now, 16 sported declining revenues in 2016, and 17 sported declining revenues over the 2-year span since 2014. Only only 2 of them are oil companies. This table shows that inglorious list in all its beauties. Look at all the red numbers, okay? That's a list of 30. That's not exactly pretty, or as the Smurfs would say, that's not very Smurfalicious. Not too Smurfy, okay? Papa Smurf, this is not Smurfy. Whoops. Oh, sorry. Wrong scene. About to give the intro. But the stock market is full of hocus pocus, and actual revenues, as reported under GAAP over time, are obscured the best way possible, just as magicians obscure their sleight of hand by distracting their audience with some flashy moves. So when I bring up revenues, everyone says, who cares about revenues? Okay, I get it. It's all about the adjusted excluding bad items, earnings per share, the great American fiction, along with leveraged share buybacks funded with borrowed money, other forms of adroit financial engineering, and crowd-pleasing new metrics. The relentless and eager focus on Wall Street hocus pocus explains, at least in part, why the Dow Jones Industrial Average has soared 73% over the 5 years to 20,000, even as aggregate revenues, despite the delirious acquisition binge, have been mired down in a sea of stagnation. The U.S. economy has not escaped the consequences of this corporate revenue stagnation, as hopes for a strong finish were gutted. And he says, here's an article to read. Back below stall speed, 2016 economy matches worst year since Great Recession. So yeah, this was worth it. When you have that many companies, the best of the best, man. Again, these are the top American supreme companies, the top 20. I mean, look at these names. 3M, American Express, Apple, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, Disney, DuPont. ExxonMobil, GE, the vampire squid, Goldman Sachs, Home Depot, IBM, Intel, Johnson & Johnson, JP Morgan Chase, my favorite bank of all, McDonald's, Merck, Microsoft, Nike, Pfizer, Procter & Gamble, Travelers, United Tech, United Health, Verizon, Visa, and last but not least, you couldn't possibly do without Walmart. And even Walmart's posting a minus 0.8, 0.8. Since when does Walmart post a negative anything? It's EBT Central. They've got people coming in with a free credit card known as EBT, food stamps, coming in and buying groceries. How do you get any negative number when you have people with free money coming into your store to buy stuff? How does that happen? Because on top of that, you have normal people, or people without EBT, I should say, not necessarily normal people, but people not on EBT, the rest of us, those of us who pay for those people who have EBT, formerly known as the middle class. And we shop there too, right? We shop at Walmart for some things, and down here in Florida, when it comes to groceries, as far as food goes, we prefer Publix. But nonetheless, we do shop at Walmart. So you have people, middle class, etc., shopping at Walmart. You have lower class EBT people shopping at Walmart. Why would there be any negative number? They should just be doing great year after year. McDonald's down from 2014, 10%. 2015, 3%, 3.1. So, again, McDonald's? Oh, it must be everybody changing their diet all of a sudden. Maybe, but maybe if the rest of these didn't show negative numbers, you might buy that argument. Caterpillar, down 30% from 2014, 17.4% 2015. Oh, excuse me, 30.3% 2014 and 18.1%. Of course, the two gas companies, Chevron and Exxon, terrible. Goldman Sachs, down. Where's old JP? JP Morgan's actually up. The vampire squid is down, and JP Morgan's actually up on 11% and 12% on JP Morgan. Isn't that amazing? Microsoft even. Microsoft, down 1.7% in 2014, 8.9% 2015. Microsoft? And that's including them subcontracting out to India and elsewhere? Wow. Unbelievable. So, again, markets rally for what reason? Tell me again. Why do markets rallying? Especially the Dow Jones. Why did it rally? Of course, last couple of days haven't been looking too good for any of the stocks, but nonetheless, this is mind-boggling. It makes absolutely no sense. So, anyway, just want to share that with you. I'm getting ready to call Mr. David Morgan on Skype for this, what's hopefully going to be a great interview for him. For me, interviewing him. And we're going to talk about his new book that was released a little while back that I've read called Second Chance, How to Make and Keep Big Money from the Coming Gold and Silver Shockwave. And I think he's got a good take on things. So we're going to see how that goes. Take care.